Hello, welcome to our professional forex trading course. Mr. Flawless, a rare currency trader and a trading coach at Flawless Execution Forex Trading. And if you are new to my channel, you are warmly welcome. And if you are returning, you are also warmly welcome. And please don't forget to subscribe to my channel, and it's the free way of you supporting this channel if you want more of this type of videos coming out every week onto your screen. So we will move on to today's lesson, and today's we are going to learn about calculating forex profit, how we calculate forex profit from forex moves. So before we can calculate our profits and losses, we have to know the number of pips we were able to capture, and also the lot size that we use to trade that particular or to execute that particular trade. So with these two things, we will be able to know our profit or loss. We will to calculate our profit or loss. So we have a formula of doing this, and the formula goes like profit as it is being written equals the number of pips times the number of lot size times the value of pip per that lot size. So every lot size have the value of pip in that lot size. So every lot size have a value given to a pip in that lot size. And before we're able to know our profit and loss, we have to know the number of pips captured and also the lot size we trade, and using this formula we're able to calculate our profits and also our losses. And this formula you don't have to memorize, or you don't have to use it, because every trading platform that is being offered to us by a broker have this programmed into that software. So it will do, the software will do all these things for you, so you don't need to get to know this that much, but it's important for you to understand how it is being calculated. So how to calculate our profit when we go long or we buy a currency pair, and in this instance we are going to use the Euro USD. So the Euro USD, we are buying Euro USD, and we are buying the Euro USD in one standard lot. And from our previous lessons, we got to know that if we're having a currency pair, so let's say Euro USD, and the Euro being the base currency and the USD being the quote currency. So with this with this one standard lot, it means we are buying 100,000 euros using US dollars. So how much of US dollars can we use to buy 100,000 euros? So this is what we are going to do. So knowing our base and code currencies, we will move on from there. Then so going long on Euro USD means the Euro is appreciating or going up, while the USD is depreciating or going down. And because we've already noticed, or we've already known our base and code currencies, we will, and we say we are going long, meaning the Euro will move up and the US dollar will move out simultaneously at the same time. So when we say we are buying a currency pair, it means, or we are trying to say we are buying, or the base currency will increase in rate, or will go up, or will be strengthened, and the code currency will be weakening or will go down. So simultaneously, so going long on this pair means the Euro will go up. We are predicting, or we are anticipating the Euro going up, and the US dollar going down. So in this form, this is what we mean by going long on this pair. So let's say we buy the euro when the market was at 1.270 and later sell the euro after sometimes at 1.1234. So we are going to use the chart to illustrate this so that we can. So let's zoom into this at this point, and we said the currency we are long on the pair is euro USD, and we are long on it. We are buying it. So let's say the market was here and we bought it at this particular point here. We bought this at this point at 1.207, and the last time I said currency codes are being stated or are being written into 4 decimal places, so we are not going to write the last 3 word here. So this is the code here. This is the code. These are the figures. These are the value of one euro in USD. So 1 euro in USD at this particular time was $1.20073 at that particular point, and we anticipated that the price will increase, so we bought here. So we buy at this point at this code, and we sell it here at this point at a rate of 1.21343. So this range is the amount of pips we were able to capture. So if we are able to capture this, the pip difference is around 127 pips. So we were able to capture 127 pips, and based on our formula, we said profit is equal to the number of pips, so 127 times the lot size, and we went 1 standard lot, so 1 times the value of pips per standard lot, which is 10. So in one standard lot, each pip represents $10. So if we multiply this, we are going to get $1,270. So from this particular trade, this is the amount of money we were able to capture based on the pips and the lot size we used in executing the trade. And another way of knowing this is also, we bought the euro here, we bought it here at this rate, and we sell it here also at this rate. So meaning we initially bought 100,000 euros using 120,070 USD. So you see, at this point we bought 100,000 euros using 120,070 USD. We use this amount to buy the euros, and later we were having the euros. Later we saw that the rate in USD have risen, or it has appreciated. We went back and sold here. So we buy here, we buy here and we sold here. So we went back and sell our 100,000. Sorry. So we went back and sell our 100,000 euros at a rate of 121,340 USD. So if you do the subtraction, we are going to get 1,270 USD. So this is how we make profit going up. So going up simply means we are buying at low. So going long means buying at low and all the way here, and selling at highs and selling at high. So this is how profits are being made when we go long on a currency pair. So don't forget to know your base and code currencies, the number of pips you want to capture, and or you be able to capture, and the lot size you use to trade. So now let's also know how we make profits going short or sell. So this year we're going to sell the pound New Zealand dollar, and with this pair, which of the pairs is the quote and which one is the base currency? So sorry for my writing, it's not nice, but I hope you'll bear with me. New Zealand dollar. So which one is the base currency? The pound here is the base currency, and the New Zealand here is the quoted currency. And always don't forget the base currency have a value of 1, and the quote currency have the value of which is the value we normally write as the exchange rate. Okay, so going on, but this time we are going to trade one micro lot. As we are going to buy, we are going to sell 10,000 pounds. We are going to sell 10,000 pounds, and also going short on pound New Zealand means pound will depreciate, pound will go down, while the New Zealand dollar will appreciate. So as I said earlier, any moment we execute a trade like this, pound NZD, that's the New Zealand dollar, NZD, we are anticipating that we want the pound to depreciate, and also at the same time or simultaneously we are also, in other words, trying to say the New Zealand dollar will appreciate or will go up. So up, down. So the motive behind going short means we sell at highs. We sell at highs. We sell at highs and buy at lows. So in simple literary terms, let's say you have an iPhone, you have an iPhone 6, which is currently, let's say, 100 USD, and based on your anticipation, based on some indicators, and based on something that you saw or news that you've heard, you got to know that in some few minutes, days, or in the future, the price of iPhone 6 will reduce to, let's say, 60 USD. So for you to make money out of that information, you will sell your iPhone at 100 USD, and later, having your 100 USD, you later go in for another iPhone as the one you were using at a smaller rate or at a minimal cost of 60 USD. So if you do this, you've gotten your phone back, or you've gotten a phone as you were using, but plus an additional money of 40 USD. So selling on forex market is about this thing. It's about how we make money selling on forex market, or selling the forex market. So we set a plan when the market is rate. So we are going to use the chart here to make some explanation. So we sell it here. We sell it at a rate of 1.9 to 1.9282. So we sell here. So we sell and later buy it here at a rate of 1.11 at this rate. So this range was the amount of pips we were able to capture, and the number of pips we were able to capture was 86 pips. Because so it will be like this: 1,282 minus 1.1996. So if we make this subtraction, we get 86. So that's why we were able to get 86. And all this, you don't need to calculate them. You have a way of seeing them, and we treat them in some other day. So with this, we were able to capture 86 pips from this move. Good. We were able to capture 86 from this move, and we know we are trading, or we execute this trade in one macro lot. So lots. So one, and one pip, the value of one pip in micro lot is $1. So we were able to capture 86 pips. Don't forget, times the lot size, the number of lot size times the value of pip per that lot size, which is 1. So in this trade, we were able to make 60 USD from this trade. So by going short means we sell at highs, and buy at lows, So this is also calculating losses on buy and sells on trade, and it goes in as we've treated earlier. So let's take example like card JPY. At 1 micro lots. So this is how we execute micro lot. 0.01. Don't forget, into the platforms, into the Forex platforms, and we are buying it. We are buying this pair. So what do we mean by this? We mean that the Canadian dollar will rise, while the Japanese yen will depreciate or go down. Simultaneously. These things happen simultaneously. So up, down. And in forex trading, forex is a zero-sum game. Before we can make money, one have to lose. So for CAL to appreciate in value, yen have to depreciate in value. So it goes in opposite directions, which make forex a zero-sum game. So with this, we said we will go up, or we want the CAL to go up, and the CAL did not go up, but it turns the opposite way of our anticipation of going up. We said the CAL was going to go up and the yen was going to go down, but later the CAL went down. It went to opposite direction and the yen went up. So let's say it went down 40 pips and we traded in nano lots, not micro lots, and it went 1 micro lot. So times the pip, the $1, the value of a pip in micro lot is equal to 0.10 cents. So with this, we lost 4 USD. This 0.10 cents. So we are down 4 USD based on the number of pips we captured and the lot size we used to trade this pair. So going short is also the same. So let's say CHF, sorry, the Swiss franc, CHF, CHF, and odd Australian dollars. Going short means this will go down and this will go up, but it didn't go this way, and instead this went up and this went down. So it made this movement. So it went into the opposite direction of our anticipation, or opposite direction of our bias, and it went, let's say, 50 pips times, and it is the micro lots 1 times. So for us to make maximum, or for us to make enough profit on our investment in forex trading, we use something we call leverage. And leverage simply means this helps trader to buy or sell big with relatively small amount of capital in their trading account. So before and this is a double-edged sword. And so let's say you have a forex account worth $1,000, and our leverage on this account is 1:50. So meaning we are having $100. And our leverage on this particular account is 1:50. So this means we can use $100. $1,000 to buy or sell a base currency worth $500,000. So what this literally means is we don't have $500,000. We have only $100,000. But based on the power of leverage, we can use our $100, our $1,000 to buy $500,000, 500,000 worth of another currency in dollars. So we only have $1,000, but we can buy or sell $500,000 per trade using leverage. And this is a double-way sword in the sense that if we are making profits, it will comes in quantity or comes as much. And if our anticipations go wrong, we are also losing much money. So in forex trading, I will not advise people to go more than 1 to 100 leverage. So your maximum leverage is 1 to 100, and that will be that. So let's say we have an account with 100 USD and our leverage is 150. So this means we are having 1,000 USD, but we can sell or buy a currency worth 500,000 USD with our 1,000 USD. Understood? So we use small money to buy or sell big based on currency, and this is what forex traders acquire to achieve exceptional highs. This is all what we use to achieve exceptionally high returns on our investment. So this brings us to the end of lesson 1 part 2, and this is what we are going to learn next week. So flawless executions, blah blah blah, and the lesson 2 is about the secret to consistent trading profits. The secret for us to be profiting from the market consistent, the secret behind this, and in that you are going to learn how to trade like the casino. The casino always win because the casino have a technical edge or a trading edge over its participants, and we are going to use this technique and apply it into the forex market for us to trade and profit from the market consistently. And we are going to also learn uh, forex is a probability, and we calculate this probability from random outcome from a number of trades. So let's say you've taken about 20 trades per month, or you've taken about 5 trades per week. How much you lose and how much you win. So consistently profit from random will also be taught, and developing a trading system with positive expectancy. As I said earlier, the technique the casino uses to have a technical edge over its participants, we are going to apply it here on the forex market so that we can also apply it from the chart and uh, develop a trading system which is positive and have a higher win rate. Thank you for watching to this end, and please don't forget to subscribe to our channel. It's your free way of helping or supporting our channel. See you in my next video. Thank you.